You hear the sirens in the back, folks? That's not me, okay? That's a test of the system. So I think we're all going to have to put up with it.
Good morning, everyone. I want to welcome you really quickly to the Mirawood Center and the FELT program today. And we have Mike Ferman returning for update and conversation about the economy and the capital markets and anything else. So Mike, I'm going to turn it over to you.
Thanks, Judy.
Oh, you're welcome.
Thank you. I think what's the old Chinese curse? Maybe live in interesting times.
Yeah.
Well, we certainly are. Where I thought I might start this morning's discussion is maybe kind of go back to the end of the year to kind of give us a little perspective on where we were and what people were thinking was going to happen in 2022, and then kind of move forward a couple months and give us a kind of a snapshot of where we are today, and then ask the $64 question. Well, so what? What do we do now? So that's kind of where I'm gonna kind of begin the conversation. As we look at the end of the year, the underlying economic fundamentals actually weren't too bad, although we were in the middle of the COVID-19 Omicron variant lockdowns and restrictions. The underlying fundamentals of the economy, for the most part, I mean, there was some couple of bad things we'll talk about. For the most part, weren't too bad. Got to think about where the unemployment rate was. I mean, unemployment was down to 3.9%. I mean, wages were rising at 4.7% year over year. The labor force participation rate, it was about 60.5, which is a couple percentage points below what it was before the pandemic. And the weekly jobless claims were below 300,000. So on the employment front, things weren't horrible at all. On the purchasing managers indexes for both the manufacturing and services sector, the monthly readings were well over 50. We had low 60s in the service sector and high 50s in manufacturing, which showed that the economy was still growing pretty robustly. Unfortunately, the CPI numbers, the stuff we go out and spend our money on every day, was up about 7% year over year at the end of the year, and the purchasing managers index, the PPI, was up 9.7%. So inflation was starting to rage. It's the highest the inflation had been in the past 40 years. There are a lot of supply chain disruptions that help contribute to that. Plus, there's a large increase in the money supply. And you may recall that the Federal Reserve embarked on a program of quantitative easing, and between the spending that the $6 trillion of money that the government spent, and all the trillions of dollars the Federal Reserve printed to fund that, that also contributed to the inflation as well as the supply chain disruptions. At the end of the year, the Fed funds rate was still at zero, although and the Fed was still buying bonds, still doing quantitative easing and printing money, although the rate that they were buying it at had slowed down. Remember that when the pandemic started, they started printing $120 billion a month. At the end of the year, it was down to 90 billion a month. And as we speak today, they're still printing money, okay, although they promised to stop printing it next month. Let's see here. And the Fed also said that they're going to start contemplating whether they should be raising rates or not at their March meeting, which is coming up in another week or so. So right now the Fed's balance sheet's at $9 trillion. And the Fed's also been talking about how they're going to reduce their balance sheet during the year to get rid of some of the excess money that they've printed. So we'll see what happens with that. The GDP, the gross domestic product, came in the fourth quarter pretty strong it was like 6.9% in the fourth quarter. And for the whole year last year, US GDP grew at 5.5%, which is really a phenomenal rate. The Fed expected GDP in 2022 to be somewhere between 4 and 5%. Again, it would be a little slower in the first half of 2022 due to the restrictions of the Omicron variant, but pick up and be a lot stronger in the second half. That's kind of what the Fed was expecting. The World Bank was looking at global GDP at 4.1% in 2022, and the IMF was looking at about the same rate for 2022 on a global basis. Again, the Omicron variant had, I guess it was real middle of December that Omicron really started to rear its ugly head, and more lockdowns and mass mandates and everything else were coming into play. As we kind of look at the performance of different structures, you can see that the S&P 500 for last year was up 28.7%, not bad. Non-developed, non-US stocks were up 11.4%. Emerging markets were up about 1.2%. Bonds actually lost money because interest rates rose. Bonds, the aggregate bond index was down 1.4%. Commodities, no surprise, were up 30.8%.
Wow.
Growth stocks here in the US are up about 32% and value stocks about 25%. So it was a generally pretty good year in the market. Also remember, Congress did pass $1 trillion infrastructure bill last year. None of that really came into play last year, but we'll start hopefully seeing some benefits from that in 2022, although that's a several year project. The S&P 500 earnings for 2021 came in around $205 a share, which is pretty good. That's about 45% growth from the prior year. No surprise, because 2020 was, the economy was shut down. And the expectations for 2022 were $225 per year on the S&P 500. That's operating earnings. And the market hadn't had a 10+% correction since probably the summer of 2020. So that was about a year and a half without a 10+% correction. That's not normal, okay? And normally markets have a 10 to 20% correction once every year, as we all are finding out, right? Let's see. So the expectation for 2022, because the Fed was going to start embarking on a tightening cycle and removing accommodation, it would have more volatility. And typically, as you look at history, when the Fed is in a tightening cycle, we have more volatility in the markets. And we are then experiencing that. So that's kind of what the economy looked like the end of 2021 and what the expectations were for 2022. So let's fast forward a couple of months and kind of take a snapshot of where we are now. Well, the unemployment rate continues to improve, and it dropped to 3.8% with last week's report. That was pretty good. The January and February jobs reports were excellent. Wages were rising at a 5.1% year-over-year rate, again up from the 4.7 last year. The labor force participation rate increased up to 62.3%, a 2% increase from the end of the year. Shows people are starting to go back to work. Remember, a lot of them have been kind of avoiding going back to the office because they were getting paid not to work. We also had people fearful of going back to work because of the coronavirus. And a lot of people couldn't find, people to watch their kids as they went back to the work. But people are now starting to come back into the labor force, which is good because that'll help with some of the supply chain constraints. Weekly jobless claims had dropped from the 286 in December down to 220 for the last week's report, which is again showing continued improvement in the labor market. The Omicron variant looks like it has peaked, and a lot of the mass mandates and other restrictions have now been lifted by most states and municipalities around the country, which will help with the reopening of the economy. The Purchasing Managers Index currently for the service sector and manufacturing are lower. They're still in the mid to high 50s. They're lower than where they were in December, but they're still showing growth in the economy. Unfortunately, the CPI reading that came out last month jumped from 7% in December to 7.5%. I think there's another report coming out later this week. I don't expect it to be very good. Okay. And again, the purchasing price, the PPI, purchasing price index was up 9.7, almost 10%, which again shows that companies are experiencing a lot of inflationary pressures on their margins. The Fed funds rate is still at 0, but the Fed said, okay, they're having their meeting this month. Theoretically, the quantitative easing is now ended because it's March, and they promised to stop doing it this month. And they're going to contemplate raising rates. And I think in his testimony last week, Chairman Powell said he would be supportive of a 25 basis point increase in the Fed funds rate in March. And again, they're going to be data dependent going forward, but the expectation is they'll have several rate increases this year. And depending on who you talk to, the expectations are anywhere from 3 or 4 to 7. Okay. Just depends what economist is talking that day. But there's going to be a lot of rate increases this year, put it that way. Short-term rates will go up. And the Fed is committed to start talking about how they're going to start reducing their balance sheet. And which also could put upward pressure on long-term bond rates. At the end of the year, the 10-year Treasury was at 1.6%. Today, this morning, it's up to 1.85%. And remember, before this Russian invasion of Ukraine, the 10-year Treasury was at over 2%. So expect that the 10-year Treasury rate's going to go up. Okay, as the Fed starts raising short-term rates, it starts to unwind its balance sheet, however it decides it's going to do that. I think expectations for the end of the year on the 10-year Treasury are somewhere between 2.5% and 3%. That's a long way from where it is right now. Okay. Let's see. The Fed has kind of lowered its expectation for growth down. Remember, it was 4 to 5% at the end of the year. Now they're looking at 4. A lot of the private sector economists are thinking even lower with what's going on with inflation and oil prices and everything else. And I think most of the private sector economists are somewhere in the 3 to 4% range. We'll see how that gets adjusted over time. Let's see here. The Fed's expectation for inflation or CPI to be down to 2.5 to 3%. I don't know one private sector economist that I've read thinks that's going to happen. Okay, I think that's very optimistic. Let's keep our fingers crossed and hope they're right, but we'll have to kind of see. But again, the Fed's going to be data dependent, and how much they raise rates and for how long is going to depend on the data. So there's no set course, but again, expectations are that rates will go up pretty significantly. Even if they raise it 6 or 7 times, remember that moves it from 0 to 1.5 or 175, which is still historically very low. Let's see. I guess the big news obviously is Russia's invasion of Ukraine, and that's kind of thrown everything in a tizzy. I guess the big impact so far has been on commodity prices. Everybody knows the price of oil today is $125 a barrel. It was up from the 90s just a couple weeks ago. So it's a pretty dramatic increase. Plus the price of all commodities is going up. Gold, nickel, everything wheat, all commodities are going up. Now, fortunately, Russia and Ukraine are not large economies. Russia's economy GDP is about the size of the state of New York's, and Ukraine's is about the size of the state of Nebraska. But Russia is one of the largest oil producers in the world. I think it's like 3rd or 4th behind the US and Saudi Arabia. And Ukraine produces about 30% of the wheat exports. Plus, Russia and Ukraine have a lot of rare earth minerals. A lot of those things that go into electric vehicles, guess where we're buying them from? Russia, Ukraine, China, places we don't want to have to buy them from. So, that's what the impact is. And there's fear or risk that this could escalate into something much larger with a conflict between obviously NATO and Russia, and nobody wants to think about what that might mean, okay? Because it's just a horrible potential outcome. That's a risk because you don't know. Accidents can happen in war. Let's see. Again, it's commodity prices are the big thing. So I have to kind of wait and see. The U.S. consumer has been pretty strong. I mean, retail sales so far this year have been very good, up 3.8%.
Wow.
Consumers here have very strong balance sheets. They still have a lot of cash. They're getting jobs and their wages are going up. And 70% of the U.S. economy is what? Consumer spending. And as the economy opens up, they're going to maybe, hopefully, keep our fingers crossed, spend more money on services. And services are 70% of our economy. So the outlook for the U.S. economy looks decent. A little less so in Europe, which is, gets 40% of its oil and gas from who, okay, which isn't good for their economy. Europe is concerned that Europe could go into recession because of the spike in oil prices and what that has an impact on their economy. Again, I think today the president is supposed to announce a ban on U.S. buying Russian oil. The Europeans, I don't think are going to do that because they are so dependent on Russian oil. But obviously, that's where Mr. Putin gets his money to fund the war. We'll see how that develops over time. Through the end of February, the S&P 500 was down 8%. As of yesterday, it was down 13%. So we are definitely in correction territory in the S&P 500. On the NASDAQ.
Lost the sound.
I'm sorry. On the NASDAQ, it was down 21% yesterday. So the NASDAQ's in bear territory. And if you look underneath the indexes, okay, there are a lot of individual stocks that are down 40, 50, 60%. So there's a bear market in a lot of stocks. Foreign stocks have been hit pretty hard, especially European stocks as a result of the war. At the end of February, non-US stocks are only down about 6.6%. But in the last 10 days, they've dropped down to negative 20%. So foreign stocks have gotten hit very hard the last week or 10 days. Commodities are up 16% so far this year. And it's less than 3 months. And value stocks are outperforming growth stocks. No surprise there. Real estate is down 13% as well. Looking at the reports from companies in the S&P 500 for the fourth quarter, and the first quarter earnings reports are pretty much done now. 76% of the companies that reported beat their operating earnings estimates. They beat them by about 4%, and 77% beat their revenue estimate by about 2.5%. But what was a little concerning is that 47%, half the companies that reported gave very soft guidance for 2022 because of everything that's going on with inflation and supply chains and operating margins and everything. There's a lot of uncertainty. So half of the companies gave very soft guidance on 2022, which just added to the volatility. It created more uncertainty. S&P 500 earnings estimates from the analysts are still, as of the end of February, at $225 a share. We'll see how that may get adjusted as commodity prices continue to rise. The risk is that commodity prices go up and operating margins shrink, and analysts have to start ratcheting down earnings. At the end of the year, the forward price earnings ratio on operating earnings was at at 21.2 times on the S&P 500. As of yesterday, it was down to 19.2. And remember, the long-term historical average is about 15.5. So stock prices are still high on a relative basis. But given where interest rates are, that's not totally outrageous, but we know interest rates are rising. The worst case scenario is that interest rates continue to rise and multiples shrink, and then analysts start ratcheting down earnings going forward because of what's happening in the supply chain and with commodity prices, because operating margins shrink. That's not a good combination for stocks. At the end of last year, the range of estimates from analysts for the S&P 500, depending again who you talk to, range from 4,800 to 5,400. We'll see how those estimates get adjusted based upon what's going on in the economy and operating margins and inflation. It's a good chance analysts will start ratcheting down some of those forecasts for the S&P 500 for this year. We'll have to kind of wait and see. Well, so that kind of begs the question, the big $64 question. Well, so what? What do we do? What do we do? Lots of uncertainty. Uncertainty creates volatility. Expect volatility. Again, it's normal, but in a rising rate environment, that's what we're going to get. Plus, you have all the uncertainty about what the Fed might do and uncertainty of how this Russia-Ukraine situation is going to work itself out. Hopefully we don't get another variant on COVID, which would really throw another wrench in the works. Who knows? Okay, I think we're going to probably have to live with that for a while. I guess the key things, given all the uncertainty and what's happening with inflation and interest rates, remember all stock prices, okay, asset prices are based upon cash flows, okay, and discounted cash flow. Is everybody kind of familiar with that? I know there's a lot of accountants on the call. I can see they're familiar with the concept of discounted cash flow, but an asset's price is they look at the forward cash flows from earnings of those companies. You discount them at a current rate. So all asset prices are negatively impacted by rising rates. And if those earnings are going down because of inflation, that just makes the asset price situation much harder to predict. So kind of focus, I think, going forward, the thing to think about is focus on high quality companies, okay? Companies with strong balance sheets, strong cash flows, they have pricing power that can raise prices, okay, as commodity prices go up. That's going to be the kind of companies that will do well in this type of environment, or do better in this type of environment. And better could be lose less, okay, as opposed to make. Kind of shy away from companies that have high price earnings ratios or high price to sales ratios, because investors aren't looking to invest in those companies because they don't have their cash flow estimates are way out in the future. And as you discount those that are way out in the future, the asset price drops a lot. And that's why the growth stocks, the high PE stocks, the high price to sales stocks have done so poorly in the past couple of months. Let's see. Value stocks, when I say value stocks, I mean more mature companies, more industrial material companies, energy companies. Those type of companies should do better because their price earnings multiples are lower, okay, than the high flyers. Watch your bond maturities, okay. As interest rates go up, what happens to bond prices? Bond prices go down. But the key thing to remember, if you buy a bond, as long as it's not a credit event, you'll eventually get your principal back. So buy high quality, okay. That's how you can eventually, avoid losing money in bonds. Let's see what else. Don't panic, because remember, panic's not a strategy. Also, hope is not a strategy either. Okay. But don't panic. Volatility is normal, and the reason we get higher returns on stocks than we do other asset classes is because they're volatile. So if you're following, if your own investment strategy is to have a diversified portfolio, use opportunities when volatility rears its ugly head to rebalance your portfolio and take advantage of it. And that's how you're going to achieve the long-term target returns that you're really looking for. So don't fear volatility, embrace it, and take the opportunities to rebalance your portfolios when the opportunity arises. Let's see. I guess one of the things we also need to be worried about is stagflation. If commodity prices rise and it slows down economic growth both here in the US and globally, and we have inflation raging, everybody remembers the 1970s, right? We're all old enough to remember the 1970s. Was not a really great time in our economy or the stock market. You had stagflation, slowing growth, and higher inflation. That wasn't good. That could impact also how analysts look at those earnings. Let's see. I think I'm going to stop here. I've been talking for about half an hour, and let's start opening up and have people ask questions, and let's have a discussion and see what's on people's minds. Linda, I see your hand.
Yes, thank you for your information. I have a managed account, so I'm not the one who is doing the buying and selling. And unfortunately, my account is going down, rapidly.
Right.
So I'm not even really sure what to tell my manager. I guess my question would be, is there, what I just say to him, aren't they going to adjust this?
Well, I suspect, Linda, and you should call him, okay, and have a meeting with him. I suspect they're using an asset allocation approach where they have stocks in, small, large caps, U.S. stocks, foreign stocks, and bonds.
Right.
Kind of ask them if they're taking the opportunity to rebalance the portfolio given the market volatility. The key thing to remember is that markets go up and down, okay, and then you're not alone when you look at your portfolio and seeing the values going down. I think just about everybody on this call is seeing that happen to their accounts. So you're in good company. Unfortunately, the key thing is to be comfortable with the asset allocation and talk to your advisor to see if they're taking the opportunity that the volatility is presenting to rebalance the portfolio, because maybe you can buy some good stuff at lower prices.
Okay, thank you.
Green, Mr. Green?
Yeah, good morning.
Hi.
Thank you very much. Very insightful discussion. Among the tech stocks, Apple, Microsoft, Amazon, which one has been hit the most, and which one do you think is the better?
Well, Apple's probably been hit the least, but they've all been hit. But
yes.
Again, the thing to remember about those stocks, those are companies with strong balance sheets, good cash flows, and pricing power. So those are the type of companies that will tend to do better, okay? There are a lot of stocks with very high price earnings multiples, or very high price, don't have earnings yet, have high price to sales multiples. Those are the stocks that are going to get hurt the worst, okay? Because they're going to get whacked by the analysts as they discount those future cash flows, which are way out in the future. So those stocks of the tech stocks, those stocks should hold up better. Doesn't mean they won't go down, because they all have, but they should hold up better.
How about the cloud? Which is better?
Cloud's been, again, it depends which companies you're looking at.
I'm talking Microsoft. I'm looking at Microsoft and Amazon.
Yeah, I mean, both of those stocks, they've come down. Okay, Amazon's come down quite a bit, and so has Microsoft. But again, there are a lot of tech stocks that have come down 50, 60, 70%. The Amazons and the Microsoft, they've come down, but not that much. Because they have stronger balance sheets and good cash flows.
Right. Which of the two do you like?
Long term, I think they're both good long term. Okay. but you might be able, you might be able to get them a little lower too. Who knows?
Okay, thank you.
Okay. I
Mayor?
saw Marilyn. I see Marilyn's got her hand up.
Okay, thank you
Hi.
very much.
Oh.
Oh, which Marilyn?
Well,
Oh.
let's Marilyn Alton first and then Marilyn Tyson second,
Okay.
okay?
Said in the Times today, the New York Times, that yesterday was Wall Street's worst day in more than a year.
Right.
It said the S&P 500 fell 3%, the sharpest daily decline since October 2020. But what I wanted to ask you was, and I know it's impossible to give an answer, where can you put your money today where you can get a decent return? It's not a CD, it's not a tax exempt or checking account. I mean, where?
You know,
There
right
isn't
now,
any place.
everything's been hit. Remember, bonds are down because interest rates are up. You know, you don't get any return on cash, okay? But at least cash won't go down. It just purchasing power gets evaporated as inflation goes up. So there's really not a lot of places right now. But remember that volatility is temporary, Marilyn, and that's the key thing. You can buy something that's down in the hope that it's going to go up later, okay, which eventually it will. Kind of think back for a minute at all the various downturns we had. Remember in March of 20, the market dropped 35%. Well, it bounced back pretty quick after March of 20, okay? In 2008, we had the financial crisis and the S&P dropped 56%.
Wow.
Guess what? It came back strong and it's a lot higher now than it was then. Same thing when the tech bubble burst. The market dropped over 50%, but it came back strong. The key thing is to find high quality assets, buy them and hold on for the long term, because trying to time the market is really hard, but you want to buy high quality assets and invest for the long term. Right now, you're not going to get much return on anything right now, but you have to buy and be patient, but buy quality.
Do you like, one last thing, do you like Verizon?
Verizon is the type of stock that's got a good balance sheet. It's got good cash flows, and it's held up very well. So it would be a safe asset. Okay, utilities, the kinds of things are going to be less volatile. Utilities, things like telephone companies will hold up better than other types of stocks. Okay, but they can still go down. Remember, Verizon was selling at over $60 a share not long ago. Now it's in the mid 50s, so it's down 10%. But that's a lot better than a lot of other things that are down 40, 50, 60%. So it'll hold up better, and it pays a nice dividend too. So you get paid to wait.
Yeah, thank you.
Steve Rudinsky has his,
Now, I think we're going to go to the other Marilyn.
oh, I'm sorry, Marilyn Tyson first and then Steve. I'm sorry.
Hi, I was wondering what agriculture stocks and futures have to do, because farmers are going to have trouble getting fertilizer. There could be a food shortage, especially in the wheat area. So how does this, if there is a crisis in the food markets, how does that interact with all the other markets?
Well, obviously there is food inflation, but think of fertilizer stocks, okay? The prices of fertilizer are going up. So if you're thinking of an agricultural play, maybe a fertilizer stock. Mosaic is an example, okay, of something that in that area. But fertilizer stocks will do well. But again, commodity and material-based stocks have been on fire, and they've actually been going up. Energy stocks have gone up as well. Energy, materials, defense stocks have gone up a lot too with what's going on. That's another area where you might find some opportunity, but they're getting expensive because everybody's been piling into them. Cybersecurity stocks, because everybody's afraid of getting hacked. Okay, those stocks are on fire. So there are places in the market where stocks have gone up. Okay, but their prices are high because everybody's been buying them. Okay. Eventually, they'll correct as well.
Thank you.
Okay, Steve. Need to unmute. There you go.
Okay, nice to hear you again. I'm just reading some headlines. USA bans Russian oil. UK,
Right.
UK joins. Shell, BP cut ties. $300 barrel of oil, question
Oh,
mark.
I hope not.
I know, but I'm just reading the headlines now.
No, I hear you. That's, no, you're absolutely right. And you know what? We could, I'm giving you a personal opinion. We could solve that problem today if we wanted to.
I know, but we can
we'll
put
see
the
what
pipeline.
happens.
We can put the pipeline back in and start drilling for oil too. But I don't
No,
know.
you're absolutely right. But obviously there are lots of somebody. Ruth gave you a thumbs up. Okay.
No,
No, we could solve that. But remember too, even if we open up our own oil production, it's going to take 6 to 12 months to get that ramped up. Okay, so we're going to have to
But
live
this
with
is
some
still a
pain for a
world.
while once they make the decision to do it.
But even if we did, this is still a world economy, so that there's a shortage. It really doesn't.
Sure. No,
even
you're
if we pump as much as we can, it's not going to change the
yeah,
price.
be prepared to pay more at the pump for the
Yeah. Now the other thing is commodities.
Yes.
Russia is big in tin, nickel, aluminum,
everything. Everything.
I just noticed that all of our major companies have come out of China, Visa, MasterCard, American Express. I saw McDonald's drop 5% yesterday. So they're probably closed all their McDonald's in Russia. So how is-
Companies are doing individual sanctions.
So what companies are going to be hit the most that have all this business with Russia?
Guess, fortunately, as we stated before, neither Ukraine or Russia are large economies. Yippee. Okay.
Yeah, but
Yippee. So they're not going to get, obviously BP and Shell are going to get hurt a lot because they've got to sell their assets at a discounted price. Okay. So don't buy Shell, don't buy BP. All right. But other energy companies, their prices are up a lot already, but energy should do well. Commodity stocks should do well. Look at the price of gold. It's over $2,000 an ounce.
It passed 2,000 today. Yeah.
It passed 2,000. Silver's every commodity is up. Every commodity.
What is this going to
is
do
up.
to all of our? If you go to the grocery store now, the prices are dramatically. And what's
You
going to
betcha.
happen when
You
this
bet-
oil
you
goes
bet-
up and
you betcha.
everything, all our transportation, everything to get the food there to the stores? We're going to see inflation at 10-15%.
Well, I'm really curious to see what the CPI reading later this week is. I don't think it's going to be good. Okay, and I think going forward, it's for at least the next few months, it's not going to be good. We'll have to see. But and buy companies that have pricing power. Okay, have good brand names that can raise their prices. All right, those companies will do well.
And don't deal with Russia.
And don't deal with Russia. Fortunately, there aren't a whole lot that have a lot of exposure. Okay. I mean, even Visa and MasterCard, only about 3 or 4% of their transactions were in Russia or with Russian citizens. I mean, 3 or 4% is not insignificant, but it's not going to bankrupt those companies. Okay.
Now, do you think
But that's why their stock prices dropped yesterday.
Do you think he's going to try to hit us with cyber attacks and hit everything here?
Putin does not, personal opinion, Putin doesn't want to lose. So, and I wouldn't put anything past him.
Yeah.
All right, let's move on. Let's see, who's
We
next? Judy?
I think Mr. Green and then Terry's leper.
Okay. Bill, you're on mute. Bill?
Okay, can you hear me all right?
Yep, now I can.
Yeah. Now in Germany, the Green Party is very, very strong.
Right.
But I think they've now approved an extension of nuclear power.
Yes, they are certainly putting that on the agenda. And surprisingly, Germany closed down voluntarily on their own the Nord Stream 2 pipeline. Yippee.
Absolutely.
Wow.
Yippee. Yippee. And that's a big deal for them because they're heavily dependent on Russia for oil and gas. That's a big step. Putin has certainly united NATO. That's probably what he didn't expect.
Well, that's probably going to be the most positive thing that's happened since this war. And with the possibility of Trump getting in next year, I don't.
No, Trump's not running next year,
Oh,
okay?
he's not?
No,
I hate,
2024 at the earliest,
I
okay?
mean, I meant 2024. I hate
But
war.
three years is a long time, who knows?
Putin's a bad man, but he did something that nobody else could do, and that's unite NATO.
He
Make it
certainly
stronger.
did that. Okay, Terry, your turn.
Yeah, maybe Judy Oliver could correct me, but I think I read someplace in a bulletin that the Mirowitz Center was going to stand behind any losses suffered by its members in the market. Is that?
No comment.
Boo-hoo, boo, boo to you.
Let's see, who else has a question here? I see Brian's waving his hand.
Yes, I'm sorry I came in late, but I heard you talking about utilities and the stock prices, I think, are going down. I'm not sure. It doesn't matter to me. The only comment I have about the stock prices of utilities is America must not care a whole lot about Americans because they are controlled, Union Electric, by a committee assigned, I think, by the governor, utility committee, something like that, and they're all political. And if somehow someone would get in to look at the salaries of all of the utilities, Peak Gas, Union Electric, telephone company locally, they're extremely high. And I know because I worked there for a while and saw what went on. They're union employees also. It's just ridiculous that we're controlled and even have stock for the utility companies of America. That's my comment. Thank you.
Okay, any
Bill-
other comments or thoughts?
Bill Livingston, do you want to unmute? Yeah.
With banking assets frozen, SWIFT being eliminating Russia, how are the oil and gas transactions being paid for?
Oh, that's put a big crimp on Mr. Putin, Bill. That's a good observation. Certainly, they're selling a lot of oil to China, who doesn't care. Okay, that's one thing that's happening. But you know, they really put a crimp in Mr. Putin's ability to finance it. But the fact the Europeans are still finding ways to buy the exemptions didn't cover purchases of oil. Okay, because Europe is so dependent on Russia for oil. So the Europeans can still buy Russian oil, Bill, but the Chinese are also buying a lot of Russian oil.
But how are they paying for it? How are the money getting transferred?
They're not exempt from the sanctions, so they can use dollars or euros to buy Russian oil. And that's part of the problem, because we're up until today, the U.S. and the allies were helping Putin finance the war by buying his oil. But the Europeans are still doing it because the Russian oil is about 8 to 10% here in the U.S., but it's like 30 or 40% in Europe. So they've got a tougher problem. So they're not exempting the Europeans from buying the Russian oil, and they're using euros and dollars to do it.
So
Who else has a comment or a question?
Well, I have another comment.
Sure.
Which is unbelievable to me, that the super rich, every article I've read, they do not know what to do with their money. Art is selling like crazy. Now Marriott and the hotels have huge profits. Jewelry selling like crazy. Louis Vuitton has one of the biggest profits it's ever had. And then meanwhile, you have the lower income that can't afford, that are being evicted, can't afford food, can't afford medicine. They had an article in the paper that a young man had to literally sell his blood to get money. So there's such a difference between, I'm sure that it's been that way before, but it just seems like there's such a huge difference now between the very super rich and the lower middle income. And, which is unbelievable to me.
I understand your point. Other questions or comments? Sheldon, you always have something to say.
Well, I'll respond to Marilyn. Marilyn, remember Marie Antoinette said, "Let them eat cake." I'm very interested in your comments, and I think we're in a volatile time. From a different perspective, I know people have been complaining viciously about what they're paying for at the pump, and I'm sympathetic to that. I understand that. But not too long ago, I can remember our parents' generation, and they had to tighten their belt during WW2, and they understood what the bigger picture was. They understood why the country went into rationing. They understood why there were price controls and wage controls, that long-term viability of this society is dependent upon some difficult choices, rash actions, and everybody's just got to tough it out.
Other comments or questions about the economy or the capital markets?
Well, we have Steve Rudinsky and then Mr. Green.
Okay.
Steve?
Yeah, I want to again thank you again for doing this. So, as Sheldon said, we live in very precarious times right now. We have a madman out there, actually deranged. No, I don't consider him any different than Hitler or Stalin or Mao, because he's genocide and war crimes. He's killing innocent men, children, women. He doesn't care. And I know on the front page of the New York Times Sunday, Putin said sanctions by the United States are an act of war. And now we've put on oil sanctions, which even makes it worse for him. As this man gets further and further stuck into a corner as his economy goes down the tubes, who knows what he is capable of doing and what the future will be.
That's scary, and that causes a lot of uncertainty, and we all
we were
know markets hate uncertainty.
We were within 1,500 feet of a nuclear reactor exploding, and from what I understood, taking out all of Europe.
Yep.
That's how close. This is not just an atomic bomb. This reactor, they said, would have taken out all of Europe.
Yeah, it's about 10 times bigger than Chernobyl, I understand.
Oh, it's much bigger, and it gives I think a quarter of all the electricity to the Ukraine. So if this man is capable of doing that, let me get rid of this. If this man is capable of doing this, who knows what tomorrow is? And I could see the market dropping another 10, 20, 30, as this thing gets worse and worse, and this guy, you'd have no idea what he's going to do tomorrow.
No, you're absolutely right. And having a little cash on the sideline is not necessarily a bad thing, guys.
Yeah, I don't think I'd be investing myself right now.
Put it this way: if it comes to the worst case, we won't have to worry about it.
I know. This man almost took out all of Europe. That fire was 1,500 feet from the reactors.
Nah, you're right, Steve. You're right. Having a little cash is okay.
Hey,
Bill,
Mr.
William,
Green,
you had a question.
Oh.
You.
Okay. Yeah, can you hear me?
Yep.
Yes.
Yeah, this is a little bit off the financial subject, but Russia only has about 150 million inhabitants. Ukraine is about 44. There are 200,000 Ukrainian soldiers, full-time soldiers, and 900,000 reserves. Yesterday, Moscow asked Syria to send troops in to aid Moscow, because all of the potential soldiers from Russia are already in Russia. So I mean, already in Ukraine. So this is a thing, the longer it goes, the tougher it's gonna be on Putin.
Well, there's a.
Which will
there's
make
a-
him more
there's a- there's
desperate.
an
That's the
explanation.
point Steve was making. If he gets
There's an
desperate, what is he
explanation.
capable of doing?
What's that?
There's an
is-
explanation.
Well, two guys are talking.
Okay. There's an explanation for Russia looking to Syria and Syrians, volunteers. The next, because that is military analysts have it, the next step in that war in the Ukraine is going to be in the cities, street by street, building by building. And it is a very high price war in terms of human tragedy. And the Syrians have been involved with that. That was the Russian-Syrian approach to taking Aleppo. And the Syrians understand urban fighting. So they want to enlist the Syrians to diminish their own fatalities in terms of when they try to take Kyiv.
In my memory, Aleppo was the same as Grozny. They were both leveled to the ground.
But they level them, but they still have to fight street by street, building by building.
I don't know what Putin's going to do when the cities, if he maintains the cities. I mean, he's kind of dead in the country. He doesn't.
And
don't know
hopefully the diplomats will find an off-ramp for him and
I
save
doubt-
everybody.
Yeah.
Give him a bigger table.
Marilyn, your hand is up.
Okay, one of the biggest, we're off the topic, but one of the biggest worries, of course, other than nuclear, is cyber. Mark Warner was on TV and he
Right.
said that's what can happen, the grids, everything. But I want to ask you a question.
Sure.
I read this by several economists and it just sounded a little far-fetched to me. It said, thanks to the stimulus checks, the unemployment insurance, and child tax credits, that Americans now have an average of 50% more money in their bank accounts. Now, does that sound right? Doesn't
Yes.
sound.
No,
Huh.
it's true. Because of all the quantitative easing, the money printing that was done, and a lot of the stimulus that was done during the pandemic, the balance
Mhm.
sheets of U.S. consumers are the strongest they have been. Okay, that's why as the economy reopens, economists were looking at, or the Fed was looking at, at the end of the year, 4 to 5% growth in 2022. They've ratcheted it down a bit, but they think as the economy reopens, because consumers have they have jobs, their wages are going up, and they have a lot of cash on. They have a lot of their personal balance sheets are very strong. That's going to support consumer spending. That is one of the premises that most of the economists today are looking at. That will help maybe spare the U.S. from going into recession, where it may not help Europe and other places.
Mhm. Thank you.
More
Any-
comments?
Any other comments or questions? Guys, this has been a lot of fun for me. Thank you for inviting me back. I appreciate it.
Thank you, Mike.
Thank you.
Mikey did an excellent job of
you.
describing a very difficult situation.
More to come. We're going to do this again, I think, after mid-year, probably in the end of July or August, and we'll see what we learn in the next 3 or 4 months.
Harvey, did you have something?
No, I was just going to ask Mike if what he thought about the government finally turning on the spigots and letting.
I think as we talked about before, we could solve the energy shortage problem ourselves if we wanted to. Remember, 2 years ago, we were producing 13 million barrels of oil a day. That's down to 11, okay? The administration could be a little friendlier to our own fossil fuel industry. Fossil fuels still supply 80% of the energy in this country, okay?
Yeah.
And globally. We have the ability ourselves to solve the problem and bring prices down if we choose to. But they have to choose to do it.
But just for ourselves, not for Europe.
Well, for Europe too, because we could have excess. We could produce more than we could use, Sheldon, and export it. Okay. a matter
But
of fact,
would-
Europe,
My
Europe,
understanding is it wouldn't make up the gap though, in terms of what Europe's gonna need
Not-
if Russia.
correct, but it would certainly help and make it easier for them to turn off Putin's spigot if they knew they could get more from us.
My understanding is though, ultimately, if Russia, we take Russian oil off the market, the only substitute for that is for the Saudi Arabia and the Gulf states to produce more, to agree to produce more, freeing up Venezuelan oil and
An Iran nuclear deal.
and letting Iran sell this product on the marketplace.
But nothing could go wrong from that, could it?
That's what it's going to take, though.
Oh,
That's what it takes
Yeah.
to shut down Saudi Arabia. I mean, to shut down Russia.
yeah. Again, we had the ability to really help that situation a lot if we choose to take it. We'll see.
Yeah. There are options.
There are options.
Yeah, I have one more question.
Yep.
It's my understanding that we use somewhere between 17 and 18 million barrels a day. Is that correct? Somewhere in that range?
I honestly don't know. We use a
That's what
lot.
I've heard. And if we're only producing 11 or we're still importing a lot of oil, it seems.
Well,
to
we're
get-
importing about 10. We do import oil. A lot of it comes from Russia. A lot of it goes to the Northeast because they won't let them build any pipelines up there.
I think it's just 8 to 10% of our
500,000 barrels
requirements.
a day.
Yeah, I'm
I
not
think
sure what our own, we were energy independent 2 years ago, producing 13 million a year, Steve. So I
Yeah.
suspect it's probably not 17 or 18, but it's probably closer to, 13 or 14.
Yeah.
My understanding, about 8 to 10% of our oil comes from foreign sources.
That's what I think too. Most of it's from Russia.
I heard today that we are talking to Venezuela. If that isn't strange bedfellows talking to each other about
Yeah,
their
nothing.
oil.
Yeah, the Venezuelans and the Iranians love us. So nothing could go wrong there.
I don't believe I saw the day when we're speaking to Venezuela now about getting their oil.
Well, they're our buddies now. Other questions, guys or gals, guys and gals? Other thoughts?
Just one comment
Yeah.
on terms of the nuclear reactor. Nuclear reactors don't explode in a nuclear bomb. You have to compress the activity, the nuclear activity. What they do is they spew radiation all over the place indiscriminately into the wind, into the soil, into the air, into the water, et cetera, and that's where the damage. That's where the nuclear damage occurs. So
Yeah,
you don't
kinda
have
like
to
what
worry
happened in
about getting
Chernobyl,
blown
right?
up. You just have to worry about getting cancer and dying.
I'd rather be blown up, I think.
All right.
Other thoughts,
Thanks,
questions,
Mike.
guys, gals?
Mike, great presentation.
Thanks, guys.
Thank you,
Thank
Mike.
you.
See you next
Well-
time.
Thanks.
We'll look at maybe the end of July or early August
Early
for,
August, yeah. We'll send some dates out, Judy. We'll get it on the calendar. This has been
okay.
fun, guys. Thank you for putting up with me.
Thank you, everyone.
Thank you.
Bye-bye.
Bye.